Hey everyone, post production, Jeremy here. So every episode I try and innovate a bit with my setups and with the episode. And what I tried to do this week was stream the show live on twitch.tv, which I did actually successfully manage for the most part. But a combination of doing that and the fact that my internet's down at my house, so I had to stream the internet on the hotspot on my phone, meant that there was a few technical issues and some stoppages and breaks. So I've edited out some of that from the recording to save you all listening to it. But if there's any jumps or whatever, just bear with it because that was the way it went down, and hopefully it'll be better next week. Hello and welcome back to the Bitcoin Cash podcast, following Bitcoin Cash on its rise to global reserve currency. Today is Sunday, the 27th of February, 2021, and I am here with imaginary username, who is a
Hello.
Bitcoin Cash developer. I guess, how would you describe yourself?
I wouldn't call myself a quote unquote developer because I don't actually write like much code compared to some actual developers out there. So I would call myself an enthusiast and operator of a bunch of services, and I just go around and do
You're in business, right? You're in business. Everyone's in business.
things. Yeah.
All right, businessman, imaginary username. Anyway, we're here with imaginary username after some technical difficulties, and yeah, powering on with it. So the price. Do you watch the Bitcoin Cash price obsessively, or how do you approach that?
It's something that I look at occasionally, and of course, obviously, I look at it whenever I actually want to pay somebody or get paid. But
Mm,
yeah, I don't. It's not something I look at like every 5 minutes or something.
yeah, yeah.
Unlike some other people that I know.
Yeah, exactly. That's right. People go through a bit of a phase, or they have different, triggers where they just get in a loop of like checking the price constantly because it's always changing. It can be kind of addictive. And if people have their, too much invested, or they don't have faith in the project or whatever, they're always kind of like, oh shit, am I going to sell out? If it suddenly
Yeah.
drops or anything. But anyway, this week it's down to 447 dollars. On the last episode, it was up like 30%, and now it's down 30%. So I always like to just check in on the price so that people can, after they've watched a few episodes or they listen to like all the podcasts in series, they just understand. Okay, it goes up, it goes down, but it's really not not the end of the world.
Well, I mean, it's basically where it was like what 2 weeks ago. So
It feels like a lot's changed, even though, yeah, exactly. It goes up massively and down massively. Human psychology is weird like that, right? Like whenever crypto gets to a high and it's so high up and then it crashes and it's still like twice the price it was before, 1 month ago. But everybody's still just, oh no, the price is down. We're all ruined. It's never going back
yeah.
up. God, people are amazing. But it's now almost 100 to 1 with BTC. So I guess that's kind of not good news. But on the other hand, it is actually pretty amazing that you can get basically 100 to 1 bet on a network that is 10,000 to 1 times more efficient. I'm personally amazed about that. Moving on. So the transactions obviously have been kicking off, and now are ahead of the BTC pretty consistently too. Not literally every single day, but they're ahead of it. But this growth curve did sort of slow down. Like it seemed like it was just going to rocket past and just keep going. So I mean, I wonder what your theory on that. My theory is sort of that maybe what happened was, as Bitcoin fees have got higher, that eventually all the people who were actually using Bitcoin regularly for any kind of payments, they sort of started to clue in that, wait a second, we got to swap over to Bitcoin Cash, and now maybe most of those people have swapped over because the fees have come down a bit on BTC recently.
Uh, so I have to be. Let's let me grab something off the top of my head.
Mm,
So I don't want to I don't really want to like go around. The recent transaction spike is mostly due to noise.cash doing
Mm,
sprinkling airdrops all around its users. That's what it is.
yeah.
Is it spam? No, it's not. It is legit use giving Bitcoin Cash to new users a few cents at a time. So it is totally legit. But is it organic? Probably not.
Mm,
Um, it's not like there's like millions of people swarming in and say that, oh, BTC fees are too high. We're all going to BCH instead. No, that's not what's happening. So yeah, I would get that out of the way first. And if we want to look at BitPay, of course, BitPay,
mm,
it's a 6-7% BCH and a little bit of Ethereum, and then the vast majority is still BTC. So
mm.
I would say that is the real usage ratio here. And then if you ask people, like, whoa, does that mean BCH should fairly be like 0.05, 0.06 BTC? Yes, it should. But yeah,
Mm.
we're not like up to BTC usage yet if you consider like commercial and organic usage.
Yeah. But in the case of that, like let's say so this noise.cash is obviously like a significant part of it. I do agree with that. Why would it have stopped then? Why did it level out? What wouldn't it keep going up if more people are flooding into that?
Well, because it's not more people,
Mm.
quote unquote, more people flooding into that per se. It's Noise.cash doing airdrop, and they're only doing so much airdrop.
Yeah.
So if they're basically giving away money at a certain speed, and at some point they gotta stop ramping up, right? So,
Yeah, yeah, true. They can't. I mean, I think, yeah, obviously a huge challenge with any product and any cryptocurrency is user retention, right? And I think historically it's been shown that, like, you have Bitcoin faucets and whatever, and people do it because they're curious and they get a couple cents, and then they think, all right, and they go back to the rest of their life and
yeah,
they forget about it, right?
yeah, exactly. And I think the plan is that if even just a few percent of those users got really interested and become enthusiasts of BCH, that's totally worth it already.
Mm.
So yeah,
Yeah, yeah. No, I think anyway, it's interesting to see. We'll see because I sort of feel like, yeah, maybe there just needs to be the next app or the next use case developed. Otherwise, maybe we might just flatline and kind of be at parity with BTC in terms of transactions. It'll be
well,
interesting to see.
Well, I mean, I don't, it is a single service. It might go up, it might go down. I'm,
Mm,
I'm fine with it. What I do hope is that this kind of what I would call inorganic traffic is eventually eclipsed by organic traffic, like
yeah,
people with hard needs to, pay their bills or participate in smart contracts, etc., etc. That kind of things. I hope that eventually it's a lot of different people, and especially we get the user count, like organic user count up. That's what I hope.
yeah, yeah. That's definitely that's the holy grail, but that's so difficult to do as every single cryptocurrency now, even for Bitcoin, right? It's not easy to get real users and especially committed users for real commerce.
They got their fees up so high that so, now nobody can see you.
Well, that's right.
Hooray!
They've screwed themselves in that respect, but Bitcoin Cash is definitely powering on in that legacy, and I think that is a significant difference between the communities. That Bitcoin Cash, it is still focused on that real world adoption. Maybe it's not happening all over the place or anything necessarily, right? But it is still like that. You can still buy stuff, you can still donate to people in the scene and all that kind of thing. It does happen, right? So like so here's another thing I saw this week as well, which is I don't know if you know Mike Maloney, right? But he's this investor, I guess, and he was really into gold and silver, so he has a company selling that. He's
Okay.
sort of a bit like Peter Schiff in many ways. But unlike Peter Schiff, he actually thinks crypto is great because he knows about money and he knows what are the properties of money and all this stuff. And he made a couple of tweets this week where he was talking about Bitcoin being gold and sort of calling out some people who were making claims about that. And then he said, like, look, I had dinner with Roger Ver, who's obviously a prominent Bitcoin Cash advocate. And then, I'm in on BCH. The title of the white paper says it all. So I just thought that was great because he has a really good videos about money and stuff. I recommend everybody to check out his channel. But yeah, he obviously wasn't buying the BTC hype. He actually sort of got to the bottom of it.
Right.
Yeah, I don't know. It just seems very interesting. But yeah, I have. If you go on bitcoincashpodcast.com, what I think about the second or third recommended link I have is to one of his videos where he breaks down the whole financial system and how it all works with the US debts and everything. So for any listeners who are not familiar with that stuff and just sort of never really understood about the debt ceiling or like any of that stuff, check that out because it's a really good explanation.
I have not personally actually read the series, but I would also like to remind people that gold is where it is today because it once was money. And so for people who want something to be gold, they probably want that thing to be money first. And
yep.
If we limit ourselves to a certain absurdly small throughput, it's a lot harder to become money, and that in fact we're seeing that over the place with BTC first, and now we are seeing the same thing in Ethereum for a different reason, but it leads to the same place. So
yeah, it's fascinating, isn't it? And yeah, this whole digital gold sort of meta narrative and stuff, I think it falls apart pretty quickly once you sort of think about
we only see what gold is today, where gold is this like hard asset that's relatively difficult to use, and nobody really uses it as money. But like gold got to where it is today for a reason, and other than maybe silver, but not really. There's like a lot of other things with scarcity around the world, but none of them occupy the space where the gold is. You don't see people using like rare earth metals for this purpose.
Yeah.
Gold was once the world currency, and everyone passed around gold coins and used that as the money. That's what it was. A lot of people just forget about that.
Yeah, that's right. I mean, this whole store of value stuff, like exactly what you're saying. It started out, it acquired use in transactions, and then it built up obviously a long history, like
it did that for a few thousand years.
Yeah, exactly. So Bitcoin trying to sort of jump on that train, it's kind of like, well, maybe in the year 5000, we'll see about that. But I think one thing it is true is that this sort of digital gold narrative sells very well to institutional investors. I was watching some videos of the Bloomberg cryptocurrency analysis or whatever, and because they don't know about cryptocurrency, but they know about gold because they understand, okay, there's stocks and assets and bonds and whatever, and then there's gold, and they already have a little mental box for it, So if somebody says to them, Bitcoin is like gold, except gold 2 or something, then they sort of go, okay, I can sort of see why I would put $100 million into this.
So I can comment a little bit on that, and this is probably also where we can learn a little bit in BCH, aside from our primary job of pushing adoption and stuff. Which is that a lot of this institutional investors, the reason they invest in any cryptocurrency at all is not just that they actually buy into this digital gold narrative, quote unquote narrative. Those narratives are, I would say those narratives are primarily for like retailers to buy their bags. Those institutional investors are not stupid.
Mm.
What they want, for the most part, are what I would say asset diversification. So, like they buy bonds, they buy stocks, they buy real estate, but asset, this asset classes, a lot of them they just want to expose to different kind of risk. And a lot of times, if they have a strategy in place, they actually care very little about, like if they buy some houses, they don't care that much about, okay, does the house look good? Does it have, is it in a good town? What's the neighborhood looks like? They don't care that much about that. They want to get exposed to this basket of things called real estate, and that's about it.
Yeah.
So what they do care is that, okay, if I buy into this asset class, um, so would it what how does it look compared to other assets? And secondly, liquidity. Can I, if I want to sell it, can I sell it quickly, and can I sell it for a reasonable price in with a reasonable spread? That's what assets are for. You buy them, and then some other time, if you want to stop exposing yourself to it, you will want to liquidate it. That's what they care. That's what assets are for. That's why they would buy. They wouldn't go send agents to go around and look for like this houses, or buy like bars of gold. They will buy securities of that. They just want exposure, and they want liquidity. That's all they want. So yeah, in that case, in that sense, BTC for a lot of them is just this other thing. They don't even care about the coins. They are perfectly fine leaving the coins in custody, like somewhere else, like Grayscale, whatever. They just want to buy into it and sell, sell it some other time, and expose themselves to different classes of risk. So in that case, you can notice that liquidity is actually quite important. And so if they want to buy into crypto, if they want to expose themselves into cryptocurrencies, they would buy a lot of BTC for no other reason than the fact that BTC has a huge market.
Yeah.
And it's very liquid, and that's it. They don't need any other reason.
Yeah. So yeah, maybe we can convert those institutional investors, but they'll be the last ones, right? Because it'll be after everybody else is already trading it, after it's already rocketed up in market cap and whatever. Then
not just that. So it is up to us. I think, to create use cases that move a lot of liquidity around. Like a lot of people say that like if you look at some other blockchains, like say BSB, they're really obsessed with putting weather on the chain. They're really obsessed with putting pictures and videos on the chain. Hey, I can put this video on the chain, and it only cost me $10 for this like huge video. That's not gonna work for increasing value, because it doesn't actually move any significant amount of liquidity. So it doesn't matter. Like, think about it, right? How big can your blockchain get? You will never catch up to even one thousandth of freaking YouTube.
Yeah.
So realistically, how much liquidity is that gonna involve? Like practically nothing. So yeah, if we want to attract like the big fish, we're gonna have to try to figure out use cases, both custodial and non-custodial, that attracts liquidity.
Yeah, exactly. So I guess we'll talk about that when we get onto AnyHedge in more detail, but I can see where you're going.
but
A
yeah,
little bit with this.
there's that. But it's not just any hedge. Any hedge in general protocols is a relatively recent thing. But the thing that BCH has always been advocating for a while, merchant adoption and getting people to pay for the things in BCH. That is a significant thing, because if a lot of people are paying for things in BCH, then a lot of people would necessarily have like significant amounts of BCH flowing around the place. People want to keep like a few $100, a few $1,000 in their pockets, and so are the merchants. That's significant compared to non-liquidity use cases. It's not just me shilling any edge.
No. Well, you're very welcome to. That's why you're on the show. But I take your point exactly. You want to be like real commerce, I guess, is quite important for that stuff rather than just having it all sitting around in vaults. So this week also that was the Fed's payment system went down, which I think was a bit of an interesting case of obviously prompted a little bit of a crisis with everybody whinging and moaning about it. And it is just interesting to see that at that scale, they still, if they want to try and make an update, for instance, or whatever they were doing, they kind of shut down their own system. And since financial markets are so 24/7 and interconnected right now, you can't really afford that. So that's something that maybe cryptocurrencies do have a bit of an edge.
We gotta keep in mind though. Most of the cryptocurrencies, aside from some really centralized one, we don't talk about them. Most of the actual cryptocurrencies are decentralized enough so that they can claim that they practically never go down. But we also gotta keep in mind that we have a long way to go, because like BCH, the network itself never goes down. And if you access it in a certain way, you enjoy that security. But a lot of people access BCH through centralized or semi-centralized interfaces, and those services go down. Those services probably go down a lot more often than Amazon Web Service or whatever other centralized things that we like to dump on. So that's something to keep in mind.
Yeah, it's true. And I mean, hopefully over time, those, the reliability of those services will increase, obviously, and also as well that we can find more ways, if you can have failover systems, like, I mean, that's quite expensive, from a business and an engineering point of view, but with time, that's not an unsolvable issue.
I think the advantage of cryptocurrencies is that if you want redundancy, you can easily get redundancy. But from a user experience standpoint, we should encourage people to get as much redundancy as possible. So
and I hope we'll see that, and I think it's interesting as well. There's a lot of we run everything over the internet, but it could be possible to be putting blockchain, broadcasting via radio waves, or doing some other different stuff. Like, I don't think that's ever got really that far, because it's a big job and there's not necessarily
I'm not even talking about those like base layer things. I think we are reasonably decentralized at the base layer to not worry about those yet for a while. But when we get higher in level, when we get closer to the user, we start seeing places where it can actually, reliability can actually be a problem here and there.
Yeah, exactly. All right, so we had as well. I don't want to turn this into a whole episode about Tether either. I might try and find another show to have that. But basically, for the listeners who don't know, Tether is, I think it's about the third or the fourth biggest cryptocurrency in quotation marks, where the idea basically is that cryptocurrencies have a lot of advantage, but one problem with them is that they're really volatile, and also that people don't really know how to handle them. So someone had this bright idea that if they basically had in a bank account US dollars, and then they made a cryptocurrency which only they were in charge of, and that they issued 100 of those tokens, then people could trade them around like a cryptocurrency. They could be sent over the internet. It would be easy to divide. You could put them on all the exchanges and all that sort of stuff, and then that people would trade those around, and then they would be able to cash them back in for the actual US dollars that you had. So this is sort of going back to that sort of centralized banking model. But of course, they immediately started producing so many of these things. That's why the number 3 or number 4, these USD tethers, there's like $34 billion of them or something like that. There's a lot. And everybody was kind of like, wait, do you actually have 34 billion sitting in your bank account? And there's been a lot of questions about that, to the point that the New York Attorney General investigated them and now fined them $18.5 million. But in the settlement, they admitted no wrongdoing, even though it says that the New York Attorney General found that they did not have the reserves. And we will wait and see whether or not this all blows up in the future. But I would not recommend, to be holding USD tethers to the listeners.
Yeah, I mean, it's the common, at the root of it is the common problem with what's basically censorable centralized service, right? They pinky promise you that anytime you want to exchange USDT back to USD, you can get some USD, but that's not all. But you gotta. They just tell you that, and you gotta believe that,
Yeah.
So.
Yeah, exactly. And we'll see. Maybe it is or it isn't. It can probably run for quite a while, because the problem with a bank run only sets in once everybody wants to get out, not just a few people. So it might carry on for quite a long time. We'll see. But certainly, if you're getting involved with USD tethers, probably just trade them around and then get rid of them as quickly as possible. Don't be.
Yeah, I mean, if you look at it from a wider perspective, Tether is just the most visible case. But if you really think about it, it also applies to general centralization of value among cryptocurrencies. So Tether is where it is, and also got the problems it has, because all of its value literally only depends on this one company, Tether Tether Corporation. So if the company falls apart, it's people run away, the bank account got confiscated, and that's the end. It's worth $0. That we talk about it as if the problem is because of lack of audit and stuff, but think about it, like the real problem there is that the value of this entire currency is totally 100% dependent on this one company. That is the real problem there. And you can actually apply to a number of other cryptocurrencies. I'm not gonna name it. I'm not gonna name any, because that will make the show a lot longer.
Yeah, exactly. A central point of failure is what you want to avoid, and also having a distributed ecosystem, right, is obviously a lot more robust. So obviously, in contrast to these sort of stable coins where the idea is it's $1 and the value never changes, and therefore investors can have some confidence or ability to trade that against different assets. I wanted to talk this week about how volatility works in cryptocurrencies, and it is one of the top things that new people, or not even especially people who are not in cryptocurrencies, they'll say, oh, it's so volatile, it could never work because it's volatile, and that's a complete misnomer. And so we've got to go through a few of the reasons, right? So the first thing to understand is that in economics, there is this idea of this impossible trinity, which is that of these 3 things, you can only have 2. And the 3 things are free capital flow, so you can trade around your currency in the world, sovereign monetary policy, so a country can control whether they print or they reduce the supply of their currency, and a fixed exchange rate is the third one. So like when you think through those three, and this would be a good point for any listeners, if they just have the audio, they can look up the slides for this show, because it's a lot more helpful if you can see it visually and think about it. But basically, if you have money that can flow around the world and you're in control of your own monetary supply, you can't pick how much the cost is, because people are going to trade it on the market against other currencies, and it's going to go up or down. So if you want to have a fixed rate, then you either need to not have the ability for your money to flow around the world. So like, I don't know, maybe like North Korea could say, we're going to fix the rate against the US dollar, and we're still in control of our monetary supply, but also it's never adjusting. But then as soon, it's only because people in the country can't trade with the outside, because if they did, it would obviously fluctuate based on the internal and the external conditions. Or you have to give up your monetary policy, so you can have a fixed exchange rate and you can have people all trading them around, but then in order to keep that fixed exchange rate, you can't really be adjusting the monetary supply according to your own whims. It has to be according to whatever the market says you need to do to maintain that exchange rate.
Okay.
Yeah, so basically, in this impossible trinity, Bitcoin and Bitcoin Cash and a lot of the other ones, they go for free capital flow and the sovereign monetary policy, where the network sets up the parameters and everything trades on the free market, and therefore they don't have a fixed exchange rate. Tether goes for the fixed exchange rate and the free capital flow, I guess. So in theory, they're not really in control of their monetary policy. But so if you were to have with the stable coins or whatever, where the volatility is like not a problem for those things, then you have to be aware that you're going to give up one of those two other.
You give up your sovereign, sovereign monetary policy, or in the case of crypto, your autonomy basically.
Yeah.
And so you're literally tethered.
True. Well said. You can give up. You can get a fixed exchange rate, but you've tethered yourself. Exactly. So there's this article which I really like. It's from 2014. It's linked on the slide. It's by Daniel Kraywidge, who I think he kind of went off and got really into Bitcoin SV, I think. But basically, he has this article called "I Love Bitcoin's Volatility," and it makes a lot of good points. So one thing is to think Bitcoin is volatile, Bitcoin Cash is volatile, but a lot of the volatility comes from the fact that it grows at an insane rate. So if you think about the price now, let's say we saw it was $450, and let's say we assume, for the sake of the argument, that it's going to $10,000. There's no way for it to get from A to B without it being volatile. Even if it was a straight line, that would still be insane volatility, and that it doesn't happen in a perfectly straight line. So if you think that cryptocurrency is going to grow, it's going to be volatile. It's a matter of fact, right?
Well, we should probably most of us should probably know what happens when you have a long period of growth with little to no volatility. It doesn't end well.
Yeah.
Let's just say that. We've seen that repeatedly in history. It really doesn't end well.
Yeah, and so that's even in the baseline case of just the facts of, obviously in growth there's going to be volatility, but even if you set that aside, the Bitcoin Cash is going to be volatile just because things change so fast. In the cryptocurrency industry, everything's always changing. Coins are, changing their policies, they're developing new features, the outside market is reacting, so much stuff is going on all the time that obviously there's going to be volatility involved. And then the last point here as well too is that because there's things are changing really fast, and like we said, the value is growing underneath to some extent, then you layer on top of that human psychology, which is the pattern of bubbles that you see in cryptocurrency, where everybody gets excited and then they all pile in, and then it goes way over the value, and then everybody gets into despair, they all sell out at the top, it has a huge crash back down, then it spends ages.
not just that, because the market has a lot of speculators. What speculators do a lot of times is that they get leverage. They get a lot of leverage,
Yeah.
and leverage by its leverage by its very nature is not terribly stable. You know, if the market is something like, say, corn, most of the well, I'm just using an example here. Maybe some people will grill me that say that, oh no, the market doesn't actually look like that because it's also been very speculative and it wouldn't be surprising the least. But if a market is mostly just people wanting to buy it to use somewhere, and people will sell it because they acquired it through some normal boring ways, then uh, when a thing when the price of that thing falls, naturally you will think that, oh, it's supply and demand. There should be more demand when the price falls, and then those demand will all come in and then buy it, and then the price will go back up. And then when the price goes up, there will be more sellers, and so the price should come back down. That's how we imagine things should work, right?
Yeah.
But in a market that is very speculative, that's not what happens. What happens is that you got a lot of leverage, you got a lot of speculators setting like stop losses, and so if you're leveraged through the roof, if you're leveraged 50x, for example, if the price falls 2%, then you're forced to sell. You must sell. So what happens in this case is that instead of this negative feedback loop that I described just now, where the price falls, there will be more demand, and then the price goes back up, and then if the price gets too high, people will sell, and then so it comes back down. What happens instead is that, oh, the price falls, the leverage people are liquidated, and they must sell. Since they must sell, the price comes down further, and the price comes down further, another bunch of people are liquidated. They also must sell, so it drops a lot. And the reverse is true when it goes up. It goes up a little bit. It goes up 5%, and then a bunch of shorts are liquidated, and then so they must buy, and then blam blam blam, it goes up 100%. Wow, holy crap! But it's a symptom of a very highly leveraged and speculative market, and that's how it works.
Yeah, of course. Because it's, yeah, like you're saying, it's a small market, it's very unregulated, so of course it is very highly leveraged because people love gambling on financial assets.
It happens even in quote unquote highly regulated markets. Just look at freaking GameStop, right?
Yeah. I hope you were gonna, I was hoping you would say that because absolutely it does. I think it's a little bit of a misnomer to think that any, significant amount of regulation would necessarily stop that issue or ameliorate that issue, but I think it certainly doesn't help not having any regulation, really. So, but for me, it's not that the end of the world that there is this volatility. Because it's good for that people who get involved in the long term, that their cryptocurrency rises in value as more people adopt. But I think it comes from you need to understand these three functions of money that it's supposed to have, right? Where it can be a medium of exchange, which means you can trade it around between people, a store of value, like we were talking about with gold and digital. You obviously in the long term you want your money to not be beanie babies. You want it to actually have value and not just be tulip mania or whatever. And the third thing is a unit of account. So when you go to the shops and you look and the price tag says $3, and you understand roughly how much value that is, right? But in this equation, the medium of exchange, I would say, for Bitcoin Cash is the most important one, and that's pretty independent from the volatility, because it can be very volatile and still be an amazing medium of exchange, right?
To a certain extent, but I think it is important for us to acknowledge that when people are using a currency in business, they will demand some baseline of stability that is unavoidable. Like it is a need. it is a need,
Mm.
and we can't just tell them, your need doesn't make sense because of this and this reasons. They don't care. It is a real need. It is there, and if we don't fulfill that demand, those people would just say that, okay, well, whatever you say is like clever, man. That's why should I care? Like, you have all those great theories, but I don't care. I'm doing business in this coin. I care that I care that I don't have to worry about going to sleep one day and then wake up tomorrow, and then the money, the quote unquote money that I received yesterday has fallen 30%. I can't do business like that. It is a real need.
Yeah.
And we can't just explain them away, So, yeah.
Yeah.
I think it's important that we acknowledge that.
Yeah. Okay. Yeah. I'm not. Maybe I'm doing a poor job of presenting. I'm not. It's not to say there's no issues with volatility, and of course for merchants, yeah, your concern is not you don't want volatility because your concern is you're trying to run your business. You don't want to be busy with all the problems with your business and busy with the problems of volatility. So you want those two things separated out. And I suppose historically that was also why there was a lot of contingency of merchants using things like BitPay, where they could receive payments in cryptocurrencies, but then they would just immediately cash them out, right, to avoid that
Yes.
volatility. And I suppose, yeah, as we'll get on to any hedge, but the idea there being that they could hold those but still lock the value in some sense. But with these functions of money, like if we setting aside merchants for a second, the volatility doesn't stop it being good money for individuals, because if it's a good medium of exchange, that's a great start. If it's a store of value, well, crypto has been a pretty good store of value in the sense that it's horrendously volatile, but it's also volatile upwards for the most part. So, which is the kind of volatility you want. And then the third thing being a unit of account and being able to price things at the shop and understand, that's like basically the least important, because we can have adoption going from where we're at now to the whole world and just price things in USD the whole way, right up until Bitcoin is the whole economy or crypto is the whole economy. And then at that point, maybe we would still price things in USD. I guess not if crypto is literally everything, but at that point, it will be large enough and stable enough that won't be as much of an issue.
Yeah, and well, I mean, I largely agree. What I have to add is just that it's not even an unsolvable problem. We have ways to get a lot better on that front, so that people are more willing to use it. And yeah, this is where this is where I get to show any hedge, I guess.
Yeah. No, it's coming up. It's coming up. I think I've got one more slide, and then we'll get into any hedge. All right. We just got to cover all the bases so that the listeners are well prepared for the background to all this. So I've got here a bit of my opinions for individual investors. Again, we'll get on to merchants. They maybe need a different strategy, right? But for individuals who are new to cryptocurrency, let's say this is the first thing about cryptocurrency they've ever understood, or they've just bought some Bitcoin Cash or something like that, here's my top tips for how to handle the fact that there is insane volatility, right? So the first thing is that just with time, you'll get more used to it. Like we were saying at the start of the show, I'm fairly accustomed to it. You're fairly accustomed to it. You just get over it eventually. The second thing is, don't invest more than you can afford to lose. If you put your entire life savings into it, obviously you're going to have an extreme emotional reaction when it drops 30% in a week, like we talked about. But just start small, basically.
Life savings is relatively tame. I think the generally good advice is do not borrow money to buy crypto.
Yeah.
No, just don't.
Yeah, I've got that. So that's the fourth point on this slide. I had the same thought, which is there's definitely, you see people posting about, it's like a Wall Street Bets type of mentality, but I think people were doing this even before Wall Street bets existed, or definitely long before GameStop or any of that, which was just being like, well, crypto is going to go to the moon, so I'm going to borrow 300 grand from the bank and then put it all in Bitcoin, and then Bitcoin went from $10 to $100, and then I'll be rich or whatever. And that's great, except for the fact that it's sort of that same reasoning of the market can stay irrational longer than you can remain solvent, right? So
Yep.
I think, just anybody, don't do that. To all my listeners, this is not none of this show is financial advice, but actually just don't take that alone.
To make it worse, if you borrow money to buy crypto, you got a few months of bear market, and then you're wiped out. Now you have to sell, and you have to sell at the bottom. It's really screwed up.
Yeah. So don't do that. Pay off your debts. Make sure your credit card interest or whatever that's charging you 15% is not ruining your life. And once you've got that all sorted, you've got a solid asset base, you're debt free. Then worry about it and put in just a little bit. Also, dollar cost averaging, because again, it's just the same thing as crypto tends to have long bear markets and then huge explosions in value. So if you get into it when it's in a huge explosion of value, well, maybe then you should just like throw in a decent amount. But if you don't necessarily know that, especially if you're completely new to crypto, you don't know what's going on. So you just figure out, okay, I want to put in, let's say $100. Let me split that up into 20 increments, $5, and then for the next 20 weeks, I'll buy $5 every week. And if you do that, you'll be less hyped up about it at the start, because it won't just be like, oh, it's all, roulette, we're just putting it all on black. It'll be more spread out, but it will also give you a sense of, okay, the market's gone up a bit this week, it's gone down a bit this week, whatever. And if the price goes up, then you're happy because your investment is paying off. And if it goes down, then if you buy lower than your previous price, you've lowered your average price. And if you spread that out over a long enough period of time, you will end up with a very good, reasonable price for what you're trying to get, even if it is fairly volatile in that time being. So that I think is huge to new users. Don't just say, I've got $100 that I want to put in, let's go on on Bitfinex and just throw it all in there today. Don't do that. Split it up.
And then do a 100x leverage, and then and then you get wiped out in like 5 minutes.
Yeah, exactly. So start small. Pace yourself. It'll still be there. Crypto will still be there tomorrow. You don't need to be a millionaire tomorrow, even though if that's what people think is going to happen. But yeah, just try not to do that. Okay, don't day trade. That's basically what you were saying, is that it's just a classic thing that people are new to crypto and they think, oh, look, if I hold on to this, I'll make 10x in their mind. But also, then if I trade this, then I can 10x my Bitcoins and the price will 10x. So I'll be like rich as hell. Just don't, you're not a genius. You're not the Wolf of Wall Street, all right? You're not going to pick exactly the right day to be buying the right coins or whatever. The market is so big and so complicated, and there are so many more people with so much more money and experience than you. It's just a classic way to throw away money,
Yep.
So, yeah, for the users, I've been there, I've done that, I had fun doing it, I lost money doing it. So give it a go if you want to do it, but literally just $10. Put in $10 and have a bit of fun, and when you've lost it all, just realize, wait, I'm not smarter than the market. Again, don't throw it all away.
Like, you are literally the market, right?
Yeah.
Everyone thinks that they're smarter than most people, but they are most people.
Yeah.
So.
Exactly. 9 out of 10 drivers think they're an above average driver. Probably 9 out of 10 day traders think they're a great day trader too. I think that's probably how it goes. Okay, now I've got two other suggestions which are a bit more long term. Like, maybe this is not when you're first getting into cryptocurrency, but they're things that can consider. So one is to get paid in Bitcoin Cash. So whether it's at your job, if you ask them to pay you in Bitcoin Cash, or whether you have some sort of like side hustle or whatever you're doing, if you can get paid even like 5% in Bitcoin Cash or something like that, then because your income will be somewhat regular, it sort of is just another version of that dollar cost averaging that we were talking about before, where if the price is going up, then you're getting paid less, well, the same amount, like the same value, but a different quantity of Bitcoin cash, but your value's going up, so you're happy. And if it goes downwards, then effectively you're getting more crypto for the same amount of work. If your salary is set in US dollars or British pounds or whatever, but your earning is actually coming through in Bitcoin Cash. So that can be another nice way. It's not for everyone, but that's just sort of another example of the dollar cost averaging. And the final one is I have a mate who has got some cryptocurrency, and he's put it somewhere that he knows he won't be able to get it for several years. And therefore, he doesn't worry about the volatility because he made a plan, and that's it.
Make sure you keep your keys. At the end, a lot of the stories end with oh shoot, I don't remember my passphrase, or I don't remember I don't know where I put my keys anymore, and yeah, don't be that guy.
Yeah. So if you're going to do this, I'm not going to tell each individual how exactly they should set it up, but figure out some kind of game plan, like where you have a friend or something, and you give it to them, but you don't tell them the password, and you tell the password to another completely unrelated person or something like that. Just figure out some sort of setup for yourself where you can stop yourself having access to it using paper wallets that you've got stored, where something. Again, I don't recommend, this is not investment advice or anything like that, but for people who think crypto is doing great, but they're worried that if they had some, they would spend all day obsessed with the price or something like that, it can be one method to manage that, is to put it a small amount, again, like we were saying before, small amounts, please, and then putting it outside their control. So then there's just not really any fretting about it, maybe. All right, cool. So let's get on to AnyHedge. You can this is your shilling opportunity. Tell me about AnyHedge. What is it? How does it work? How are you involved? Just go for it.
Right. So this idea came from basically what happened what happened few, yeah, I think it's a couple months, but I'm not terribly sure about exactly how many days it was. But it was after the activation of the opcode check data sync on Bitcoin Cash, which at the time of its activation, everyone think that it's an opcode to read external data, and we can use it to create simple oracles, and that's about it. So people have came out with use cases where they it can be used for like a gambling oracle. People can bet that prices would go up. People have bet that on sports or presidential elections or whatever. Yeah, that's what people thought. But then, a bit later on, people figure out that I think the first time I read about it was a write-up that was outlined by this pseudonym called Tendo Payne, who outlined that, hey, we can actually use it to do covenants. I wouldn't go very deep into the technical details of what a covenant is, but essentially it opens up to a very wide variety of use cases where not only you can read oracles, but you can now also restrict essentially through a smart contract where the contract pays its coins to and how much does it pay, and apply other conditions on top of that. So that was very powerful, and people were going around and coming up with new use cases for that. One of them is Lyco's Macenas and Last Will, which was pretty cool. And there was Tobias Rugg, who I think made a little cool on chain like confident chess thing, which is, I'm not sure what that is for, but it was cool as hell.
Yeah.
So and then I tried to think about it. I was like, okay, so yeah, these things are all cool, but they all have their little niches. But we still have this one problem remaining that was unsolved, which is that people who operate on BCH have to be worried about BCH price going up and down all the time. Their eyes are glued to the price. They can't move away, and they can't. It's a terrible way to run a business.
Yeah.
So while thinking about that, I came out with a look. I look at how other markets operate. I mean, I have a little bit of prior knowledge in watching how those markets work.
Yeah.
Things like, say, the airline industry, for example. What does the airline industry run on? It runs on oil. And, oil is much less, let's just say that oil is much less volatile than cryptocurrencies.
Yeah.
But compared to, say, US dollars or the Chinese yuan, it is still a lot more volatile. Like oil, at the extremes, it can go up or down like 10% a day. And that's during extreme times. And even during non-extreme times, it's not unheard of that oil can go up or down like 20% in a week. That's like normal.
Yeah.
That happens all the time. So if you are an airline or you are a tanker company, your entire business runs on oil, and oil goes up and down all the time. It's a terrible way to run business.
Yeah.
They are in a similar predicament as businesses running on cryptocurrencies. Well, they deal with it anyway. So how do they do it? So the way they do it is that they establish a market where they buy futures to lock in prices at a certain level, and once they lock in, they give up some of their profits to the speculators on the other side, but in exchange they get stability, and once they get stability, they can actually do accounting, they can calculate costs and profits, and have peace of mind. They can do long-term planning. They actually get to run their business a lot more comfortably. So it's a win-win. That's how they work with a volatile asset that is oil or pretty any kind, a lot of other commodities. So I was like, okay, that's how they work. Can we apply the same principles to BCH? And I look at it a little bit, my initial intuition is that yes, it can. And then I sketch out how it probably should work. And then I went around asking people. I went around asking a couple of people who are, more experts at smart contracts than I am. Mark Lundeberg being one of them. And the answer is that it actually kind of makes sense, and that's basically how it began.
Right. Cool. So I read through the white paper and everything, but for the listeners, the summary of it basically is that, let's say if I had $100 of Bitcoin cash and I didn't want the value of that to plummet. Basically, I guess nobody's ever really sad if it goes, up, but you can't you can't have it both ways. You can't have it only going up and not going down. So if I wanted to
Yeah.
guarantee that I have $100 today and that I have $100 tomorrow with any hedge, I can make a smart contract which is put into the blockchain and which nobody can really mess about with, which means that I make a deal with somebody else that they are going to put up a certain amount of Bitcoin Cash themselves also to be taking the speculative part of the risk. So if the price goes
Yes.
up, essentially, then they're getting paid by me because I'm only going to have $100 at the end, and the price has gone up. There's more of it. It's getting distributed over to them,
Yes.
and then the reverse is true. So if the price goes down, well, then they are paying me so that I stay at $100 value. And then what you're saying about the Oracle is that's the price feed basically. So it might be well, I guess
Yes.
maybe right now there's not necessarily all that many of them, but there could be in the future. It could be the New York Times, or it could be whatever crypto company, or something that says we will guarantee that we are publishing the correct price every 10 minutes or something, so that your smart contract can check and adjust the levers.
Yes.
Yeah.
Yeah. You got. I think you got a nice summary there. It is basically what it is.
With what you were saying about, so I didn't know actually that detail that you said about it came from the implementation of these opcodes in Bitcoin Cash, because I know what I do know is there was a lot of the opcodes got disabled in BTC, right, and then they got put back in BCH. So is that one of the is that one of these
No,
ones?
it's not. No, it's not. It is a novel opcode on Bitcoin. It is a novel opcode on Bitcoin Cash. It was not present on BTC at any point in its history.
Right. So they can't do this. So they would have to add that opcode if they wanted to add this same functionality.
Yes.
Okay, interesting. Well, they're ahead of the game there. That's good. That's good news. That's really good to hear. So, yeah, I mean, I guess so. I had a few thoughts as I was reading. I've just put here on the slide. So, one thing I found was I thought about this. I understood the idea and everything, and then I thought, oh, okay, great. I'm gonna try it. I'm gonna go out. I'm gonna put in $50 and lock it in for a day before we had this call, and see for myself how it works and all that. See if I could, or maybe take the other side of the trade and get paid some interest and everything. But is there like implementation of it? It sounded like yeah, this is the
Yes,
protocol.
and
There is?
this is a general problem. This is a general problem all around. Is that having an idea that is possible doesn't mean that you got an implementation in the product.
Yeah.
Having a protocol, having the protocol enable something doesn't mean that you have a practical implementation out there. And having a practical implementation out there doesn't mean that you have a business actually running on it
Yeah.
and offering the service to the general users.
Hmm.
Luckily, what happened after we got that idea is that I got together with a few entrepreneurs. One of them is John Geary, Emergent Reasons, whose
Yeah.
name is also on the white paper, and one other is Jonathan Silverblood,
Hmm.
who has done a few excellent projects on Bitcoin Cash, including but not limited to cash accounts. Uh, some some people might a lot of people might remember that it is still running,
Yeah.
and a lot of people still use it. So got around with a few people, and yeah, General Protocols, the company was born to push this idea forward and offer practical implementations. And then General Protocols later found another company D-Token, who wants to do decentralized exchanges, and they saw the promise in this, and they want to provide, a front end, user acquisition, front end, and liquidity for it. And General Protocol aims to do the backend much of the backend service, and implement the actual smart contract. And so it involved quite a few people and a lot of capital from both ends. But yes, the result is that today there is an implementation that you can use right now, that you can go to dtoken.net,
Uh-huh.
and basically just do that.
All right, cool. Because I didn't get onto this last night.
It
Here we
is
go.
it,
All
it,
right.
it is not perfect. There's basically only one kind of contract offered, which is daily 3-to-1 contracts.
Yeah.
And the token has some, the performance is not perfect. Sometimes it goes down. Even when it goes down, your funds are not at risk because it's not custom. But
Yeah.
sometimes it goes down and then it frustrates people. But it is there, and there's a long way to go, but it is there.
Yeah. No, this looks awesome. I did not know about this. I might have to give this a go then after the
Oh yeah.
show. I'll put in some cash and see about this. And so this is then a way, yeah, like you're saying, it's non-custodial. So for listeners that aren't familiar, basically what that means, and it's sort of related to this decentralized finance movement that is really big at the moment, but which I'll have to go into detail in another podcast episode about. But basically, the idea is that even if you're using this service like dToken or whatever, they are not in control. It's not like if you go to a bank and you give them the money and then you do use some financial product, but if the bank collapses, well, then you're just screwed. Or even in crypto, if you go to an exchange and you put your coins on the exchange, well, the exchange is in charge of it all. So if they collapse, like the famous incident of Mt. Gox or 1,000 other of these crypto exchanges, you're screwed. But if in DeFi,
and it's gone.
yeah, exactly. It's the personification of that, South Park scene where we've got $20 and it's gone. We've got 5 Bitcoin and it's gone. Well, the idea with DeFi is that it's not like that, and instead you are sort of still in control, and just by the blockchain, these more advanced smart contracts and things, creating a situation where you still own the money even if you're using this other service or whatever. So if they disappear for any way, well, they don't have control of the money. They were just providing the service, and at the end of the day, the money will still sort of return back to you if it was locked in some contract, or play out according to the contract, independent of whether or not their service has problems or gets bought out or goes broke, or all the things that happen in the world. So this is interesting. So it's up to 3x, or it's exactly 3x? Did you say it was only 3-to-1?
It is only 3-to-1. I think when they created it, I think they tried to future-proof it a little and allow for more possible pairs. There are probably other options that will come later.
Yeah, and one interesting thing here, we've got earn on this website, but it was something I picked up that was very interesting in the white paper, was the idea that you can have either side of the contract, so either the person getting the stability or the person getting the volatility, aka the profit or loss. Either side can be the side that pays an interest rate of an arbitrary amount to the other, right? So we'll see a market emerge, right, where people who want the stability will offer to the speculators, we're willing to pay a 0.5% premium for the locking in this volatility. But you could also have the other side where speculators could say, I really, really want to speculate. If somebody else, like a merchant, we will actually pay you to lock your crypto in at a fixed rate.
Yes, and I wouldn't go into details on how the algorithm actually works. I mean, part of it is really just in control of the token. I wouldn't even say that I fully know exactly how they control it. But the gist of this is that there is since the entire market is made up of hedges and longs. If there is overwhelmingly more demand for one side versus the other, then the side that is in high demand will have they're desperate to open contracts. They think the price would go up tomorrow and it will go up a lot. So they will have to pay the other side to open this contract. It's supply and demand, right? That's basically the gist of it.
Yeah, and I mean that's a super cool idea because well, I don't know if these kind of things exist in traditional finance, but they probably do in some form or another, like you're saying with the oil and everything like that. But in the crypto world where things move around at such an insane speed and the price is so volatile, like we talked about before, and it's also globally accessible, that just this might end up being used by, like you're saying, merchants spread all over the globe and whatever, then we might get some really interesting insights from the fact that at certain, like let's say if a bubble starts and the price is rocketing up, then the demand might shift quite dramatically as to who wants to be locking in their volatility and who doesn't, and whatever, right? And another sort of aspect to this is that it's all settled in BCH, but the price oracle can be for any arbitrary. Is it any arbitrary information?
Well, I mean, as long as there is a price, and as long as someone is willing to run an oracle, then yes, it can be done.
It has to be a price that has to be like a
it,
numerical value. You can't publish like a boolean.
So sorry, what it?
So it has to be okay. So I need to try and sort of explain this so that users who are not super in detail can follow along. But so basically, what I'm asking is that you can have this all runs on Bitcoin Cash, but they've already got us or the option to have you can speculate on the price of Bitcoin Cash like we were talking about before, or you can speculate on anything else. So you could speculate on the price of gold or US dollars.
In this case, it is important that if you read into the white paper a little more, you would realize that the interesting nature of how this works. At the base layer, this very first product that we are talking about, we talk about, oh yeah, you can speculate on the price of Bitcoin Cash, but no, it's actually the other way around.
Yeah.
Essentially, you are operating in Bitcoin Cash and you are speculating on the value of the USD.
Yeah, exactly.
And so, if you think about it in that paradigm, then, we call it hedge and long because that's how people usually think about this. They just cannot put it in their minds that, oh my God, USD is actually a commodity and we are using BCH as money and speculating on that. They cannot put it in their mind.
Yeah.
So we put it as hedge and long to, make it easier for them to
hedge and
create
short,
this
right?
image in their head. But what it really is that there is a hedge who wants to, who wants to peg their BCH value against USD, and then there is a short. There is the speculator who comes in with their BCH and they're shorting the dollar. That's what actually happens.
Yeah. And I mean, it's fascinating, right? Because for me, I think, it is this sort of inversion of the paradigm that people come to cryptocurrency because we've been inured in this system of fiat currency, like we were talking before with unit of account and everything, that you think, I go to the shop and this is something is worth this much, right? But in the, people also look at these graphs of the Bitcoin price or Bitcoin Cash price against the US dollar. But the way I think about it, and the way I think people sort of are shifting towards as they become more involved in cryptocurrency, is at some point the graph in your head flips and you think about it as, oh, I have this much Bitcoin Cash, and then the value of the USD is sort of fluctuating against that, right?
Yep. And it's not something that happens tomorrow or in the future. It's already what's happening right here. We just present it in a different way so that people are not freaked out about it.
Yeah, exactly. And the reason that the Bitcoin Cash has to be the asset is because that's the programmable part of the collateral, right? That's why
Yes.
it's based that way.
Yeah, that's the I would say, quote unquote, that's the free part of the money.
Yeah, yeah.
So yeah, back to your original question. Yes, you can make a number of things. You can do a number of pairs, or any pair, for example. That's where the any of the any hedge comes in.
Yeah.
As long as someone is willing to run an oracle about it, you can have BTC versus BCH.
Mm-hmm.
You can have gold versus BCH. You can have freaking potatoes versus BCH. um,
Yep, I'm sure we'll see. Yeah.
and then and I think there are some people who asked, oh, right, but can I do gold versus USD? And for that, I would say that somebody would have to be the long BCH part in it. But as long as that speculation part exists, yes, it is possible to arrange for something like gold gold price in dollars. It would just be a more complex setup, but it's possible.
So when you're doing that, would you do that uh, like in a scenario where one person had gold versus one person had Bitcoin Cash versus USD, and somebody else had gold versus Bitcoin Cash, and then by combining those two, somehow you could make it gold to USD. Is that the idea?
Yes, as it is. It's a more complex setup, so it's probably not the biggest priority next, but it is conceivable.
Right. Yeah. Yeah. Obviously, yeah. None of this stuff is going to get built tomorrow. This is very. It gets very complicated very quickly.
It takes time. It's programming. There are an endless amount of bugs to be fixed. So
yeah. Exactly. Yeah, but I mean, I think already the fact that there is an implementation of this, I'm quite amazed about, because I did read it in. I read it through it all, and I just didn't realize that there was a way to try it today. But I can see that will very rapidly advance, and I'm sure as well that as part of the system, there will surely be there'll be some outreach to exchanges and so on and so forth, right? I don't know how much involved you are in sort of the business part of that. Can you talk about that, or do you know about that, or is that information you can share?
Sorry, can you repeat that question? Like, I think I got kind of lost in the middle of it.
Right. So as far as with any hedge and the plans for the future, so they've sort of teamed up with D Token to do an implementation of this. But is it also going to be available on other cryptocurrency exchanges, or is there an active move to?
General Protocols is actively contacting a number of exchanges. I wouldn't name them because there's no like official partnerships linked or anything out there. But essentially there are two routes to go here. One is that we can keep expanding towards any exchange who wants to open up an entirely new market, which is this decentralized non-custodial hedge and futures engine, basically. It is, I would say that, and it's not an easy job, because for most exchanges, even the more technically competent ones, they are perfectly happy with the traditional model where they are custodians of everything. They're custodians of everything, and they just you put your coins in, and then the coin disappears into the void. And then they tell you what happens, and then when you withdraw your coins from them, you go to the withdraw screen, and then you tell them, okay, pretty please, I want to withdraw. And they say, yes, you may withdraw. Thank me later. So they are perfectly happy with that model, and not to mention that a lot of exchanges aren't even that technically competent.
Yeah.
There's a rise of like white label exchanges where the operator doesn't even need to do anything. Someone else supplies their engine for them, and they just click yes and yes and yes, and then they put up some fancy pictures in front, and then voila, you got an exchange. So it is this is a new product, and it will involve a lot of convincing and technical wrestling for exchanges. But yes, it is something being worked on. The other route is that essentially eventually we hope that we can get to a point where there is a relatively decentralized platform where anyone can strike up contracts with anyone. Like maybe in this very this is one of the possibilities. Like maybe in this very conversation, I can tell you, okay, you know what? I want to hedge. You want to long. Let's do it.
Yeah.
And then we do it like right on the spot. And then perhaps people can meet on some other yet to be developed and yet to be designed decentralized platform. But that is another route, and I think both ways has their pros and cons in terms of user experience and how much security or liquidity they will get. But yeah, there are many possibilities.
Yeah, I mean, I think it's mind blowing. I mean, being an engineer myself, when I look at this stuff, I sort of get a little bit intimidated because somebody's going to have to write a lot of code to make this all work. But obviously the concept and the financial power of it is immense, and it will rapidly expand, I'm sure, as well, because once you've got one thing and you've built that and that's stable, then you can add on the next thing, like we were talking about doing different asset pairs, neither of which are crypto, and I'm sure there's more things after that that will occur to me or you or anybody who's using this stuff. Whatever there is demand for, the market will eventually provide, so it's a very interesting world.
It's not just that the market would eventually provide. One thing that we have learned a lot through this whole, it's not just any hedge or general protocol, but the whole Bitcoin journey is that a lot of times, just because you think a demand exists somewhere, it doesn't mean that it will be addressed immediately. A lot of times, it only gets addressed like much later, and then you ask, wait, why is that? Because the efficient market hypothesis is a lie, and
It's all a lie.
Somebody actually has to step up and do it, and people who are capable and willing to step up and do it are in short supply.
And they're already busy.
Believe it or not, they are in short supply. So this is also something that I want to tell whoever is listening to the show, is that if you think this is a valuable thing that needs to be done, and you look around and don't find any obvious people who are doing it, maybe that guy is you.
Yeah.
Go ahead. Don't wait for anybody.
Yeah, that's exactly it. Like that was the genesis of this podcast, right? I mean, there are Bitcoin Cash podcasts as well too, and in fact I found out about a few more after I started this, right? But I think either way, I sort of felt I had my own take on different things, so I just sort of thought, well, we'll just crack on and start it. It's been going really well so far, so I totally agree with that sentiment, which is one thing that I've started thinking about of it is that the Bitcoin Cash as a organization, or as Rick Falkland would put it, as a disorganization or as a movement or whatever, it probably has the resources to fix whatever issues it needs fixed, but that's an active rather than a passive process, right? So the community can
Yes.
self-fund or self-create any tools or any shit that it needs, but we're all just sort of like parts of the hive mind.
Yeah.
But the more active you are in that process, the more it will just magically turn into something amazing, kind of.
Yeah. Yeah. There are two sides of the coin. One side is that the community can do this, and the other side of the coin is that you are the community.
Exactly.
So
Yeah. Yeah, yeah, and you've got to see it in that lens as not, yeah, what is the community doing for me, but more what can you bring to the community? And I think
yeah.
people who are bringing valuable stuff or putting a lot of effort in or creating whatever they're doing, then it starts to feed back on itself, right? Where people reward you or they're interested, and then or they link you up to more other people who are doing similar stuff or whatever, and it all gets better for everyone, and that's really quite amazing and especially important in a cryptocurrency where the value comes from the community very directly rather than being sort of a result somehow of people living in the same geography.
Yeah.
Yeah. All right. Cool. Well, we've been going for an hour and a half. Is there anything else you wanted to bring up about any hedge or about cryptocurrency generally, or what's been on your mind recently with Bitcoin Cash? How are you feeling about things?
So far so good, and as you said in the beginning, the price could use some improvement. The ratio could use some improvement.
Yeah.
Um, but I would say that the fundamentals are pretty good. But on the other hand, there's a lot of potential, but as I said just now, all those potentials that people think are possible, and people think that, the market should eventually come to its senses. You are the market.
Yeah.
Go ahead and do it, and so if you are developers, there's a lot of places in Bitcoin Cash which are hiring right now. General Protocols being one of them, um, and I think there are a few other places too. Well, there's General Protocols, and there's BCHN and Electron Cash. You know, there's resources, and if you're capable, go try it out, and you can maybe it's a start of a great career. And on the other hand, if you are an entrepreneur and you see that, okay, yeah, but this I see this smart contract thing. I have a different take on it, or even if I have the same take on it, I see that, oh, this general protocol guys, I don't think they are doing a good job. I can do a better job. Well, go do it. Don't wait for anyone. So yeah, I just want to let people know in general that it is not enough to just see other people, to just watch other people do things. Um, you can make a difference, and to push this peer-to-peer electronic cash to the world, and make some money in the process.
That's
So
right. It's
yeah,
good for everyone. It's good for the community, and it'll be good for you. It'll be good for you too if you're putting up results. I think that's certainly my attitude. So I completely agree with that, 100%. And even though it's not something that people are, yeah, accustomed to with fiat currencies or whatever, that is the world of crypto. Is basically you get out what you put in very very directly, and also in the macro sphere. So it's quite actually a change in the economy, even if it doesn't seem it at the surface level, which is these things, they don't magically come from nothing. It's all the combined effort of lots of different people. So You know, first time doing the live stream, so there had to be some issues with it, right? Nothing ever goes right the first time. But yeah, basically, yeah, I don't know. People can donate to the show if they liked it, obviously. The slides and resources are all at bitcoincashpodcast.com for anybody who wants to check out the links and everything. I want to say thank you to the people who donated for the last episode, pseudonymously on Bitcoin Cash. I always appreciate it. It's always great. Haven't got any subs on Patreon, but I also haven't got any rewards or anything for them, so fair enough, you know. And yeah, I hope everybody's enjoying, and thank you for being on the show with me.
Oh, thank you for having me.
It's been good, and yeah, anything you want to shout out? People can go check out AnyHedge. Where can they find that?
Yeah. Well, I mean, I pretty much just shield like dtoken.net in the show.
Yeah.
If you are a developer or a potential partner, if you are an exchange or trading desk or just some developers wanting to make apps around it, go check out generalprotocols.com and anyhedge.com and make contact. Yeah.
All right. Well, generalprotocols.com. There you go. Get involved, people. And now I'm going to check out the Twitch stream, which I have not had open this whole time because of my dodgy internet. So we'll see if we got some viewers there or not. Maybe we can chat to them. But otherwise, I hope everybody enjoyed. And until next time.
Okay.
All right.
Thank you.
Cool.